This is Nightly Business Report with Bill Griffith and Sue Herrera.
Solid gains. When the week started, few would have guessed it would end like this, at records.
Hiring spree. Retailers are in search of workers for the holidays, and in this labor market, they could be hard to find.
Up in vape. Teen use of e-cigarettes is on the rise. Sales are soaring, creating a big challenge for public health officials. Those stories and more tonight on Nightly Business Report for finally a Friday, September 21st.
And we do bid you good evening, everybody, and welcome. What a week on Wall Street. Stocks did what few thought they would do. After the White House on Monday announced those tariffs on an additional $200 billion of Chinese imports, most expected the market to decline. But instead, equities unexpectedly took off, and they kept going, reaching new highs along the way. And it happened again today. The Dow finished the gain with a gain of 86 points today to close at another record, 26,743. The Nasdaq fell 41 points as technology continued to lag, and the S&P fell by 1 point. The Dow and the S&P were higher for the week, especially the Dow, which added 2%. Here's a look back at an impressive week.
Stocks fell into the close amid those increasing trade tensions.
The White House has released details of those new tariffs on Chinese imports worth approximately $200 billion.
China has made good on its promise to hit the U.S. back with tariffs.
The tug of war over tariffs.
Our impact in 2018 is going to be about $40 million from tariff-related costs.
Manufacturing is growing in this country. This trade war has the potential to set us back.
Investors seem convinced both sides want a solution and a deal here.
People are making a mountain out of a molehill.
Every time there's a new semi-negative headline in trade, everybody gets spooked, but I think investors tend to realize that this is just some noise.
The S&P and now the Dow hit some record highs.
It was a historic one. S&P record close, 12th of this year, 100th record close since the election.
The year-to-date gain in the S&P is going to be pushing 10%.
You've had a real risk-on feel this week.
But is the rally moving too far and too fast? Mike Santoli looks at the market that has defied expectations.
The Dow's recent run to its first record high in nearly 8 months has taken its gain this year above 8%, with all of that progress coming since late June. The market has carried higher despite persistent trade friction with China and through what historically has been a tough stretch for stocks in August and September. The question now, are stocks running too hot, perhaps burning some of the fuel set aside for a potential fourth quarter rally? Or is the market suggesting the environment is just right for now, with a brisk U.S. economic pace and extraordinary corporate profit growth carrying well into the second half of this year? The observable signals are mostly encouraging. History says that an index hitting a new high is a better indicator of a market's strength than vulnerability. Stock markets overseas have bounced, relieving some fears of stress building in the global economy. The rally has become a bit more inclusive in the past week, comforting some strategists who saw the market as too narrowly driven by big tech stocks. And the advance has also occurred as traders come to terms with a growing likelihood that the Federal Reserve will raise interest rates 2 more times this year, once next week and perhaps again in December. This has pushed the 10-year Treasury yield above 3%, helped financial stocks, and implies that investors feel the economy is sturdy enough to absorb somewhat higher interest rates. Working against these constructive messages are some familiar concerns. Stock valuations based on expected earnings have again moved toward the upper part of their range for this bull market, particularly when compared to bond yields also near a 7-year high. And both earnings and GDP growth appear poised to decelerate into 2019, even as the Fed projects further rate hikes through next year. A year ago, the major indexes were up by a similar percentage on a year-to-date basis as they are now, and accelerated higher from there through this past January. But of course, a year ago, the market was eagerly anticipating the tax cut in December that has already provided businesses with a big boost in 2018. It all boils down to a fairly upbeat picture with no clear signs of a U.S. recession on the horizon, but just how much of the abundant good news this market has already priced in remains an open question entering the year's final turn. For Nightly Business Report, I'm Mike Santoli.
Meanwhile, across the Atlantic, Brexit talks between the United Kingdom and the European Union have hit an impasse, and a frustrated UK Prime Minister Theresa May today challenged the EU to come up with its own plan, one day after her proposal was rejected.
The EU should be clear. I will not overturn the result of the referendum, nor will I break up my country. We need serious engagement on resolving the two big problems in the negotiations. And we stand ready.
And as the talks grow more tense, investors are becoming concerned that a deal will not be reached, and that caused the British pound to fall sharply against the dollar and the euro. The UK is scheduled to formally quit the bloc in March, and believe it or not, that is less than 200 days away now.
Meanwhile, a top White House official today said that the U.S. and Mexico were prepared to move ahead on a new trade deal without Canada. Kevin Hassett, chairman of the Council of Economic Advisors, said that the revised NAFTA agreement could end up being a bilateral rather than a trilateral deal. He added that the U.S. and Canada are still talking, but that a U.S.-imposed deadline looms at the end of the month.
And Walmart is warning that additional tariffs on Chinese imports may force it to raise prices. In a letter to the U.S. Trade Representative, the world's largest retailer says the cost increase could hit essential items, everything from food and personal care products to bicycles, pet products, cribs, even backpacks. The company says the results will be consumers either buy fewer items or none at all, meaning that suppliers could receive less and retail margins could shrink. And rival Target said today it is also deeply troubled by the escalating trade war, which it says threatens to undermine the economy.
Time now to take a look at some of today's upgrades and downgrades. AT&T was upgraded to buy from neutral at UBS. The analyst says the stock is trading near all-time low valuations. The price target is $38. The stock rose 1% to $33.78. Under Armour was upgraded to neutral from underweight over at JP Morgan. The analyst cites the company's turnaround and expects it to meet earnings estimates for this fiscal year and next. The price target is $20. The stock closed right around that level at $20.57.
Nike's price target was increased to $100 from $85 at Barclays. The price target is now the highest among Wall Street analysts. The firm praised innovation at the company. Nike reports earnings next week. In the meantime, the stock rose a fraction to $85.55. That is an all-time high. Home builder Pulte Home was downgraded to underweight from overweight at JP Morgan. The analyst cited below average order growth at the company. Price target now $28. That stock fell a fraction to $26.26.
The labor market is tightening, and some even describe it as booming. Yet despite the low rate of unemployment, a curious thing is taking place, creating a bit of an economic puzzle. Steve Leisman pieces it all together.
Despite a decades-low unemployment rate and somewhat higher wages, Americans who have dropped out of the labor force are defying expectations and not coming back. At 3.9%, the unemployment rate is as low as it's been in almost 2 decades. But the participation rate, that's the percent of the population saying they want to work, has been stuck for nearly 3 years at around 63%. That's the level it was back in 1977 before women came streaming into the workplace. What's happening is that the strong labor market has brought some people in the prime working age of 25 to 54 back into the workforce. But it's not enough to offset the baby boom retirees, more and more of whom are picking up golf clubs every day and retiring.
We're not getting enough of a return to the workforce to offset the forces that are going to be in play for the next 2 decades.
The question is, can the U.S. bring any of these workers off the sidelines to staff the strong growth in the economy? There's no one-size-fits-all solution.
For women, I think employers have to offer more flexible work. Many of the women who are out of the labor force are taking care of families, they have household responsibilities, and they report that they're content with their lives. That's not all women, but that's many of the women. And if you look where the U.S. lags behind other countries, labor force participation of women is now relatively low, and we used to be among the highest in the world.
For men, economists say there are issues with opioid addiction, disability, and training that need to be addressed. But there's also the big issue. Why don't employers just pay more?
There's been a real reticence to raise wages. A lot of companies have told me, we could raise wages, but then everybody else would do it. So what's the point? So it's a bit of a collective action problem. But I do think that there is some solution to this, and that comes in the form of higher wages.
One idea, the Federal Reserve should keep interest rates as low as it possibly can for as long as it can, even risking some inflation to help push up wages and see if that gets people off the sidelines and into a job. For Nightly Business Report, I'm Steve Leisman.
And in fact, getting those workers back into the labor force is exactly what retailers would like to see, because they plan to ramp up their hiring in a big way this holiday season. Courtney Reagan has more.
Forecasts suggest it will be a strong holiday season for retailers, and hiring signs are out at stores, websites, and delivery companies. So far, the retail industry has advertised more than 300,000 seasonal job openings, a number that's expected to more than double in coming weeks. While the number of seasonal jobs is expected to be close with past years, with unemployment at historic lows, it may be harder to fill the roles, which could lead to a more frustrating shopping experience.
I think we're going to see a lot of shortfalls. That means even more lines. You also see retailers sort of broaden their search and bring in people they wouldn't have usually brought in. Usually, one of the best indicators of how good the economy is how bad the service is, because they can't staff up enough during these tight labor markets and better economic times, and the people that you get behind the counter have less skills. That is the reality. It also means they're going to have to pay up for people.
Since retailers often hire from the same labor pool as hotels, restaurants, and even construction, the hiring package needs to be competitive. Target is starting pay at $12 an hour for seasonal workers, the same as the rest of its year-round staff. Macy's seasonal employees will be eligible for bonuses, just like its full-time staff. The department store CEO Jeff Gannett is confident Macy's will find the 80,000 holiday workers it needs. He says Macy's is more of a consideration than it used to be, partly because of its new company-wide bonus program and its current sales momentum. Retailers have already started hiring for the holidays. Kohl's began its holiday hiring months ago to have the first crack at the best employees and to have time to train them. On job site ZipRecruiter, there were 2 times as many retail job openings in August than last year, with openings far outpacing applicants. Students, recent grads, retired individuals, and gig workers like Uber drivers are among those that could fill the jobs at stores, websites, and delivery companies during the holidays. The gig economy is a big part of an alternate workforce, which job website Glassdoor estimates is made up of about 16 million Americans retailers could potentially recruit. The tight labor market may make it harder for retailers to fill seasonal jobs, but for holiday workers, it also means a jollier opportunity with better pay and incentives. For Nightly Business Report, I'm Courtney Reagan.
Still ahead, flooding threatens a key North Carolina industry, its crops.
Farmers in North Carolina are trying to salvage what they can in Hurricane Florence's aftermath. For some, the storm could not have come at a worse time for this critical sector of the Tar Heel State's economy. Seema Modi is in the small farming town of LUCAMA for us tonight.
It's a race against the clock for many farmers in North Carolina to salvage as much of their crop in the wake of Hurricane Florence. Wind and rain damaged much of the tobacco still left in the fields. And Scott Farms, a family-run, 14,000-acre operation, tells us it could lose 25% of its tobacco crop.
Obviously, it has been damaged. Fortunate that a lot of it has been gotten in so far. Where it goes from here, we don't know.
The farm also grows sweet potatoes, which makes up about 70% of its revenue. They were still underground when Florence hit, halting their harvest. Scott Farm says the crop could see losses of 20% or more.
Harvesting sweet potatoes, we have a narrow window of when we can get them harvested. We need to get things harvested before frost hits, it gets cold. So when an event like this comes and we're out for a week and can't harvest, it narrows the amount of time that we have to get the crop into the house. And so it's a problem that you deal with up front, and it's also a problem you deal with down the road.
The impact of Florence's heavy rains is being felt across the state, where agriculture is the #1 industry, employing 1/6 of the population. Sanderson Farms, one of the country's largest poultry producers, warned in a statement this week that bird losses from Florence will affect its fourth quarter. And so far, 5,500 hogs have died, nearly double the number lost during Hurricane Matthew in 2016. Due to excessive flooding, a number of lagoons are at risk of releasing pig waste into the floodwater, raising concerns about water contamination. And if that wasn't enough, tariffs are weighing on North Carolina's $87 billion agriculture industry. China is the state's top trading partner for ag products, and tariffs imposed in July hit key crops like soybeans, tobacco, and pork. But most farmers across the state are reluctant to comment on tariffs. Strickland Farms in nearby Mount Olive says it wants to see a level playing field with China, though admits that the ongoing trade dispute has inflicted pain on their business. For now, farmers across the state are focused on rescuing as much crop as possible. For Nightly Business Report, Seema Modi, LUCAMA, North Carolina.
Medtronic inks a deal to grow its medical device portfolio. That's where we begin tonight's market focus. Medtronic said it was buying the rest of Mazor Robotics that it doesn't already own for more than $1.5 billion. Medtronic said that deal adds more robotic-guided systems to its spinal surgery technology. Shares of Medtronic rose a fraction to $97.85. Meanwhile, shares of Mazor Robotics popped 10% to $58.15. Royal Dutch Shell is reportedly in talks to sell its stake in an oil field in the Gulf of Mexico to help pay for its $50 billion takeover of BP Group. Bloomberg says that deal values Shell's position in the field at nearly $1.5 billion. Shares of Shell rose a fraction to $67.28.
British online fashion retailer Farfetch made its debut on the New York Stock Exchange today. It priced its initial public offering at $20 a share. That was $1 above the high end of its expected range, giving that company a market value of more than $6 billion. And it was an impressive first day of trading. Shares gained more than 42% to $28.45. And McDonald's says it's hiking its quarterly dividend by 15% to $1.16 a share. The fast food chain has now raised its dividend for 42 consecutive years. Mickey D shares rose nearly 3% today to $165.30.
It is time now for our weekly market monitor, who says you can still find value in this market, even at these levels. The last time he was on, in October of 2017, he recommended Wynn Resorts, which is up 46%, Sonic up 40%, and Penske Automotive Group, which is 2% lower. He is Trip Miller, managing partner at Goulet Capital Partners. Good to see you, Trip.
Good to see you. Thank you.
You are sticking with Wynn Resorts. The company did have a bit of a rough patch earlier when Steve Wynn stepped down, but the overall longer-term performance of the stock is good.
Yes, we've been very satisfied over the last year, although in the last 6 months, the stock has pulled back meaningfully. And as long-term value investors, we're looking for businesses that qualify both qualitatively and quantitatively, and Wynn certainly does that. We feel like under new management, new board leadership, under Matt Maddox's lead with the company, that we've got exceptional management in place that can execute the long-term plan that Steve Wynn began. And on top of that, they have irreplaceable real estate assets and brands, and we believe catalysts that are coming along both in Boston and internationally in Macau that will drive earnings even higher in the coming years.
Quickly, you've got Spectrum Brands on your list. Interesting company, everything from plumbing supplies to shaving supplies here, but the stock has suffered mightily the last couple of years. I guess that's why you like it?
Yes, we've been buying into it recently on the pullback. We've watched it pull back significantly over the last year, but there, similar to Wynn, we have a management change in place under Dave Mara, and we have a legendary investor, Joe Steinberg, on the board as well, who did an exceptional job over many decades at Lucadia. They'll be selling off their Rayovac brand this year to Energizer, and that'll generate about $2 billion in cash that they'll use to pay down debt. Also buy back roughly $1 billion worth of stock over the next couple of years. Okay. And we believe that their free cash flow and earnings are growing. So we like that one as well.
All right, let's finish up in our last 30 seconds with FedEx. Also, strong leadership.
Yes, absolutely. Under founder Fred Smith, who owns about 7% of the shares, and his team, we've been long-term shareholders and believers in FedEx. As you mentioned, the stock is down, but we believe that they're growing free cash flow and earnings at a high rate, and they're in a duopoly in their space that, with their acquisition of TNT, is only going to make them stronger in Europe.
On that note, Trip, thank you so much. Trip Miller with Goulet Capital Partners. You can read more about his stock picks on our website, nbr.com.
Coming up, how Canada is taking the lead on cannabis.
Marijuana stocks got a lot of buzz this week. That was partly due to Tilray, which, as we've reported, was up sharply midweek, halted multiple times, only to end in dramatic fashion with a 30% fall today.
And just as investor interest around cannabis is growing, wouldn't you know, Canada is getting ready to legalize recreational marijuana next month. Kate Rogers is in Cobourg, Ontario for us tonight.
Licensed cannabis producers across Canada are gearing up for the end of marijuana prohibition. The move, implemented by the Trudeau government, makes the country the first G7 nation to legalize recreational use of the plant, while cannabis remains illegal at the federal level in the United States. Longtime cannabis executive Chuck Raffici is hoping to cash in. The CEO of Auxly has invested in 14 different operations from growth to research and retail. His one concern, there might not be enough product on store shelves.
I think we will see empty store shelves because we've seen it in every other place in the world that has legalization. And there will be a lack of product over the first year. Many of the producers across the country are ramping up production, but there's still a bit of a lag for that to catch up.
Another unknown in this sea of green is the market size for the Canadian industry. Analysts have said it could be anywhere from $4 to $10 billion in the first few years. Analysts expect those numbers to grow as multinational companies from Constellation to Coca-Cola make and explore deals, bringing the product more mainstream. And more investment is expected.
I don't think there's anybody that's not eyeing an opportunity in cannabis. I do believe that there are many people on the sidelines, many companies on the sidelines vying for an opportunity.
Another thing industry insiders are watching, what this means for the U.S. market.
Hopefully we can show America and the rest of the world that legalization is the right thing to do. It's very important, I think, to put the money back into the people's hands. Government will generate a lot of revenue, a lot of taxes. It will add a tremendous amount of jobs, especially to small town America. And I think it's really important that the world gets to see this and hopefully follows Canada's lead as a G7 country.
As Canada takes the lead on cannabis, the rest of the world is watching. For Nightly Business Report, I'm Kate Rogers in Cobourg, Ontario.
But Philip Morris says it has no plans to enter the cannabis market. The CEO said the company already has enough on its plate, adding that it is tasked with the challenge of getting traditional smokers around the world to switch to smoke-free tobacco devices, which are a growing part of Philip Morris's business.
Elsewhere, a new report says electronic cigarette use is soaring among teenagers. The Wall Street Journal says the number of high school students using e-cigarettes has risen by 75% in just the past year. Betsy McKay co-wrote the story for the Journal. She joins us tonight. And the FDA is very much paying attention to this, and they're trying to stop what the Scott Gottlieb calls an epidemic, right?
That's right. They have, just last week, the FDA said it was starting to, considering banning flavoring in these products, in e-cigarettes, because that's a real draw for teenagers.
Yeah, and it has ultimately addiction qualities to it, and that can lead to very difficult health challenges and costs down the road, right?
That's right. I mean, these products have a lot of nicotine in them. They certainly aren't cigarettes, they don't have the toxins that tobacco has, but they have high levels of nicotine. And, public health officials and doctors worry a lot about nicotine in developing brains. It definitely can have an effect on the brain as it develops. And your brain is developing until you're about in your late 20s.
By far the biggest company in this industry right now is Juul. They make what teens love. It's a very hip-looking kind of a vape device with the flavors and everything. But the industry itself is relying on the teen market. That's where the biggest growth is. So if the FDA is able to stop that growth, what happens to this industry, do you think?
Well, one of the big questions actually is, where is all this growth coming from? I mean, the e-cigarette business, all across the board has been growing a lot in the past year, led by Juul. I mean, Juul is a real innovation and breakthrough in this market, and now others are copying it. And so one of the questions until, this year is how much of that growth is actually coming from teen use. The data that we reported starts to help answer that because there hasn't been any data out there in 2018 yet. But, it still is an open question. It's hard to know with sales how much of it is going to teens. They're not necessarily the ones actually buying the products.
Right. how does a company like a Juul, and there are others in that space as well, walk that fine line, being in compliance with the FDA, but still trying to sell its product and make a profit?
Yeah, it's tough. I mean, they say their target is adult smokers, and when it comes to flavorings, for example, which is what the FDA has its eye on right now, they say that's important for adult smokers. You know, people who want to quit smoking want to get away from the tobacco flavor, they say. But flavors are what are drawing teens. So they're trying to reach out more to adult smokers, but they've got a very active teen market right now.
That is for sure. Betsy McKay with the Wall Street Journal. Interesting story. Thanks for joining us tonight.
Thanks.
Before we go, let's take a look at the final numbers from Wall Street. The Dow rose 86 points to a record 26,743. The Nasdaq dropped because of technology. The S&P 500 fell 1. The Dow and the S&P were higher for the week. And what a week it was,
Indeed.
right?
Yep.
That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a wonderful weekend. We'll see you Monday.